Slow. What if I told you that in just a few hours, rising tensions between the United States and Iran wiped out billions of dollars? From global markets sent oil prices flying, pushed gold higher, and left traders staring at their screens in shock. This isn't just another political headline. This is the kind of geopolitical spark that can shake your portfolio, your retirement account, and even the price you pay at the gas pump. And if you trade Forex, commodities, or indices, this is the kind of moment that can either create massive opportunity or painful losses. Before we dive deep, make sure you like this video and subscribe to the channel. On Forex Trading Rocket Signal, we break down major market-moving events in simple, clear English so you can understand what's really happening and how it affects your trades. Hit that subscribe button now so you never miss a critical market update. Let's start with the big picture. When tensions rise between the United States and Iran, the market doesn't wait for official statements or full details. It reacts instantly. Traders don't like uncertainty. And geopolitical uncertainty is one of the most powerful forces in global finance. The moment headlines hint at military action, sanctions, or retaliation, investors move fast. Stocks can drop within minutes. Oil can spike in seconds. Currencies can swing sharply without warning. Why does this happen? Because markets are built on expectations. Investors are always pricing in what they think will happen next. If there is a risk of conflict in the Middle East, traders immediately think about oil supply. Iran is a key player in global energy routes. Threat to shipping lanes or oil production raises fears of supply disruptions. And when supply fears rise, oil prices often surge. Higher oil prices can lead to inflation concerns, which then affect interest rate expectations. Suddenly, what started as a political story becomes a full-blown financial chain reaction. At the same time, stock markets usually react with fear. When uncertainty increases, investors often reduce exposure to risky assets. They sell equities and move into safer assets. This is known as a risk-off environment. You may see major indices slide as fund managers protect capital. Technology stocks, growth stocks, and emerging markets can feel pressure first because they are considered more sensitive to global instability. Now, let's talk about currencies, because this is where things get really interesting for Forex traders. During geopolitical tension, safe haven currencies tend to strengthen. The US dollar often benefits, not because the United States is involved, but because it is still considered one of the world's primary reserve currencies. In times of crisis, global capital often flows into dollar-denominated assets. This can push pairs like EUR-USD lower and strengthen USD against weaker currencies. But here's the twist. Sometimes the dollar reaction is mixed. If the conflict risk directly involves US military action, investors may worry about long-term economic impact, higher government spending, or political instability. In that case, gold can become the bigger winner. Gold has a long history as a safe haven during warfares and geopolitical shocks. When tensions between the United States and Iran escalate, gold traders often step in aggressively, driving prices higher within hours. Silver can behave differently. While it is also a precious metal, silver has a strong industrial demand component. That means if traders fear global slowdown due to conflict, silver can experience sharp volatility. It may spike first with gold, then pull back if recession fears grow. This kind of movement can confuse new traders who expect both metals to move in the exact same way. Another key factor is oil. Oil is often the fastest moving asset during Middle East tensions. A single headline about threats to shipping routes or military buildup can cause a sudden spike. Energy traders know that even the possibility of supply disruption can tighten markets. Higher oil prices then ripple through global economies. Transportation costs increase. Manufacturing costs rise. Consumer prices can follow. Central banks are forced to watch closely. And speaking of central banks, this is where long-term market direction can shift. Oil-driven. Inflation rises. The Federal Reserve may face pressure to maintain higher interest rates. Higher rates can strengthen the dollar, but also weigh on stock markets. So, what looks like a short-term geopolitical event can slowly evolve into a monetary policy story. Smart traders don't just watch the headlines. They watch how policymakers respond. Let's slow this down and think emotionally for a moment. Imagine you're a fund manager responsible for billions of dollars. You wake up to news that tensions between the United States and Iran have escalated overnight. Don't know if this will calm down in 24 hours or turn into a larger regional conflict. What do? Most likely, you reduce risk. You trim stock exposure. You increase cash. You buy some gold. You hedge oil risk. Multiply that decision by thousands of institutions around the world, and you get massive market volatility. Now, here's something important. Not every spike or crash is manipulation. During fast-moving geopolitical events, liquidity can dry up. When there are fewer buyers and sellers in the market, price moves become sharper. Algorithms also play a big role. High-frequency trading systems scan headlines in milliseconds. The moment certain keywords appear, automated trades are triggered. That's why sometimes markets move before human traders even finish reading the news. For retail traders, this environment can feel overwhelming. Spreads widen, stop losses get hit quickly. Emotional decisions increase. This is exactly why having a clear trading plan matters more during crisis periods. On Forex Trading Rocket Signal, we always emphasize risk management first, because in volatile conditions, protecting your capital is more important than chasing every move. Let's talk about opportunity. Volatility is not just risk, it's also potential. Large price swings create strong trends. Breakouts can run further than usual. Momentum trades can become powerful. But the key is discipline. If you over-leverage during a geopolitical spike, one reversal can wipe out days of gains. The goal is not to predict war. The goal is to react smartly to confirmed price action. 2. Another layer to consider is market psychology. When headlines use words like escalation, retaliation, or military response, fear spreads quickly. Social media amplifies panic. Traders begin to expect worst-case scenarios. But sometimes tensions cool down faster than expected. Diplomatic statements can reverse part of the move. Oil may pull back, stocks may recover. This is why experienced traders avoid emotional extremes. They wait for confirmation instead of reacting blindly. It's also important to remember that markets adapt. First, shock is usually the strongest. If tensions continue but no major disruption happens, volatility may slowly decrease. Investors become used to the situation. Risk premiums adjust, prices stabilize. That's why timing matters. Early reactions are often the most explosive. For long-term investors, events like this are reminders of why diversification matters. Having exposure across asset classes can reduce overall portfolio shock. For short-term traders, it's a reminder to monitor news closely and trade smaller position sizes when uncertainty is high. As we move forward, watch 3 key things. First, official statements from both governments. Words matter. Second, oil price behavior. Sustained spikes signal deeper concern. Third, central bank reactions. Any shift in rate expectations can extend currency trends beyond the initial geopolitical move. If you've made it this far, you already understand something powerful. Markets are not just numbers on a screen. They are reflections of fear, expectation, and strategy. Rising tensions between the United States and Iran are not isolated political stories. They are catalysts that can reshape equities, commodities, and currencies in real time. I'd love to hear your view. Do you think this tension will calm down quickly, or could it create a longer-term shift in global markets? Drop your thoughts in the comments below. Your perspective helps the entire Forex Trading Rocket Signal community learn and grow together. And if you found this breakdown helpful, share this video with another trader who needs to understand what's happening right now. Make sure you're subscribed, turn on notifications, and stay connected. In times of uncertainty, information and discipline are your strongest assets. Stay smart, stay calm, and I'll see you in the next market update.